Hello everyone and welcome again to yet another session of SteelMint Engage 4.2, the Virtual Connect webinar series. This is the 5-day webinar series and we have covered a range of topics relating to ferrous and non-ferrous metals till now. Today's session is also an interesting one, focusing on the Indian long steel market. I'm Lalita, editorial analyst SteelMint, and your host for this session. I have with me Mr. Prateek Srivastava, General Manager Steel Operations, who will be co-hosting this session with me. Hi Prateek, how are you?
I'm good, Lalita. Thanks a lot.
I would like to take this opportunity to thank the Indian Steel Association for supporting SteelMint's webinar series. Before we start the session, a request to our audience that we will take your questions too during the discussion session with the speaker. So please drop your questions in the chat box with your name and the company name. Now coming to the topic of discussion, which is emerging market opportunities in the Indian long steel industry. We already had a session on the same topic a couple of days back, which was from the seller's perspective. But in this webinar, we will discuss the buyer's perspective. With this, I'm introducing you all to our speaker for this session, Mr. Shantamay Chattopadhyay, Assistant Vice President and Head Procurement, GR Infra Projects Limited. With a total of 27 years of experience, Mr. Chattopadhyay has expertise in strategic sourcing and procurement, EPC procurement, and supply chain management across power, steel, cement, and infrastructure sectors, commodity and category management, and project management. A very warm welcome, sir.
Thank you.
Now, to set the context for this session, I would like to invite my co-host Prateek to give a brief overview of the current scenario of the Indian long steel market. Over to you, Prateek.
Thanks, Lalita, for giving the introduction of our speaker, Mr. Chattopadhyay. I will set the context with respect to our session today. The Indian long steel market has witnessed a continuous fall in prices for the past 18 consecutive weeks. Demand from the infrastructure and construction segment has remained strong in January due to restocking activity in the distribution network and procurement by buyers for the completion of projects within the deadline, as it was the last quarter of the fiscal. From end of February, there was a slowdown in market activity, which resulted in a decline in prices. Demand remained sluggish as buyers were cautious about placing orders amid fears of further price fall and resorted to only need-based procurement. Prices are likely to remain under pressure in the near term as the monsoons are likely to hit India in the coming days, which are expected to slow down the construction activity. So we will learn more about the on-ground scenario as well as what the second quarter of the year could have in store for the long segment. Without any further ado, I invite our speaker, Mr. Chattopadhyay, to share his perspective about the long steel market. Over to you, sir.
Thank you, Prateek. First of all, I really appreciate the effort that SteelMint has taken for conducting such a webinar, which is really depicting the story of the market, the latest trend, the dynamics in which the market is moving. And I really appreciate your effort to bring in to such a platform as a guest panelist to really talk about, from the buyer's perspective, how it moves. And thanks to Lalita also for setting the context of this webinar. So without wasting a further minute, I will get directly into the topic, in which I would start with the fact that Indian steel industry is is one of the major markets in steel right at this moment, because after China, if somebody is really producing this much of steel, it is India. And the infrastructure development in India is also going in a rapid pace, and with a lot of new infrastructural projects which are coming up, be it in the roads and the highway sector, be it in the power transmission sector or hydro sector, tunnels, railways, metros, and all the infrastructure are moving in a very rapid pace. And now that we are also coming out of the geopolitical tensions which was there a year back, the COVID, which has created a lot of denting into the market, that has also wiped off, and we are having a bit of positive sentiment as regards the market is concerned. And going forward, we have the election, the next year, the national election, we have the state election. So the platform is well set in a positive note to really take the industry in a northern directions, and which is good for the overall health and the health of the industry, which is really good. Now, I want to show you the typical things which are happening in the steel market. And particularly this will, I just want to present because I have the data to present, which will tell you the story, how it is moving. So just I am getting into my presentation. Yeah. So this is a buyer's perspective on the emerging market opportunity in Indian long steel industry. I think many of you have already got into the series of webinars that has been running in the last 3-4 days. And the seller's perspective also people have seen. Now, before I get into the buyer's perspective, I want to show you some of the data which will really bring lot of insight about the scenario. So for steel, as we know that from the input material point of view, be it the primary steel or the secondary steel, there are two things which are the most important input raw material. One is the iron ore, and one is the coal. The coal could be coking coal or the non-coking coal or the thermal coal. So now in the iron ore segment, I just want to show all of you that iron ore prices in the last 2 years, you can see the cyclical order in which the iron ore prices have been moving. And today, the iron ore price, if we talk about the Australian origin with 62% Fe, it is almost at the low end in the last 2 years. And it is, you can see 2 years back, the price was at $225. And today the price is something around $116 in the Australian origin, that's 62 Fe. Now, if we talk about the NMDC prices here in India, so there also you can see that iron ore prices in the month of in few months back also was hovering at around 6,000, 6,200, something like that. And today it is less than 5,000. It is around 5,200, and it is on the downtrend. So now that means it is almost at the bottom stage. So we can see that the iron ore is really bottomed out almost. And if there is anything that can happen, it can either remain stable for the demand being not that high and the monsoon is just knocking the door. And also, or it could rise over a medium term period. So if I look about the coking coal or the non-coking coal, so here also we can see that from the Queensland mines that the coking coal is coming from Australia. And the coking coal also, if you just see the graph in the last 2 years price, so we are almost at the same level.
So sorry for interrupting. We can't see your presentation.
Just a minute. Can we see now?
Yes.
Sorry for this trouble. So I will go to the, yeah. So iron ore, just I will take 1 more minute because you could not see the presentation. So iron ore price is almost at the bottom, be it the Australian origin, that is the international iron ore prices with 62% Fe. And also the domestic prices, which is from the NMDC that we captured. And here we can see that the price is on a downtrend of the iron ore. And with the monsoon knocking at the door and the demand is not also that much picked up. So iron ore prices will continue to remain flat or at the downtrend. And we believe that this is a time where the prices is almost bottomed out. And now that if I look about the coal prices also from the Australia, if we see the coking coal, which is one of the prominent source of the primary steel segment, here also the coking coal prices at present is almost at the 2 years low. It has touched almost the 2 years low. And if anything can happen at this stage, it would either remain at this stage for a month or so, and then it has to rebound. So that means the price is all set to go up in the coking coal segment. Even if we look at the South African price, that is the Kumba mines, whatever the non-coking coal which is coming to Indian secondary steel market, the thermal coal, here also we can see that the price is at 2 years low and all set to remain at this stage, or even a likely jump that can take place from now onwards. All the thing that monsoon may keep the sentiment a bit low as regards the projects are concerned, but there is all set to increasing the price from this point onwards. Now, if we talk about the other raw materials like met coke, that is the met coke price, which is a ingredient to the blast furnace. So BF grade met coke price is almost in the last 2 years, it is also at a very low level. So anything that can happen is a increase from now onwards, or maybe in a month. So this is what is the situation for coke and the coking coal, the met coke and the iron ore. If we talk about the other intermediate products in the segment, like the sponge iron and the pig iron. The sponge iron is for the secondary steel production and the pig iron for the primary steel productions. Here also we can see the price is almost bottomed out, and both the trends shows that a rebound can happen from this period onwards. So sponge iron and pig iron is almost bottomed out in this case. The melting scrap, which is another ingredient for the secondary steel productions, or the electric arc furnace, that is who are there in the recyclable steel productions. So they are also, if we look at this European melting scrap price or the American melting scrap price, so this is at 2 years low. So this is almost bottomed out. And at this level of price, there is seen to be a resistance, and possibly from this point onwards, the prices of scrap may not drop further and it can go up. So this is what is the scenario in the scrap prices. Now the ferroalloys, which is another raw material for steel productions, here also we have seen that the ferromanganese and the ferrosilicon prices are at 2 years low. So all the data that I am presenting depicts the story that the raw material or the input material prices have bottomed out, and there is all set of increase in the raw material prices from this point onwards. So the cost of producing the steel, which is at a low level, and accordingly the price of long steel is also at a low level, may go up from this level onwards, and we should not be in a mindset that price will further dip. Even if price dips, it could be in the range of 500-600 rupees from now onwards because of this monsoon and all. But in medium term, the price is also to increase from now onwards. So this is what is being shown here. If we talk about the rebar prices and the wear rod prices, so here also we can see that the rebar prices, you can see how much in the last 2 years the rebar prices have changed, and we are almost at the bottom stage of rebar prices and the wear rod prices. The rebar prices had touched quite a high level the last year during April and May, and then after it has dipped and come to a stage where there is no further dip envisaged. So likewise, what I said for the input raw material, even the rebar prices, that finished long steel price is all set to go up from here onwards, with a maximum further decrement of 200 to 500 rupees in a very short term, and then after there could be a sudden jump. And the jump, whenever we have seen in the steel market in recent past also, it goes to the extent of 8,000 rupees to 10,000 rupees a ton, and which is a sizable increase. Having said that, that means we should be prepared for an increase of around 18 to 20% in the steel price in a medium term. That means from the third quarter and the fourth quarter will remain bullish. At least it is expected to remain bullish, and that kind of increment can take place because all the producers will increase their price based on the raw material increment. and also the sentiment moving up, particularly after this monsoon is over, of the positive sentiment that we have in infrastructure sector, all the projects will boom like anything, and steel price is all set to increase in the third and the fourth quarter. So if we talk about, this is a graph that we have taken about the steel prices, how it has moved, particularly the rebar prices, the long steel prices, how it has moved in the last 2 years. And this is a data that we have captured for both the primary rebar price and the secondary rebar price. So here also you can see that both the prices have really gone through a sea change from 75,000 rupees to 54,000 rupees for the main producer prices, and 62,000 rupees to 50,000 rupees for the secondary steel producer prices, and which is almost at the bottom stage. And we might not expect, or we should not expect much decrement from this level onwards. There is also set for increase. And in the 2 quarters after monsoon, we can expect the price to be at the level of, again, 60,000 or 62,000 rupees, if not a bit more. But by and large, the price is all set to be at that level, which is quite a normal expectation right at this moment. So with these data in mind, I believe that from the buyer's side also, we have to be prepared to take advantage as well as to take a corrective measures as to how we should really look at the steel procurement, particularly all the infrastructural contracting companies who has got a huge order booking and huge order backlog to execute in the third and the fourth quarter. Because of the demand push in the third and the fourth quarter, they should be geared up from now onwards to see that what kind of strategy for the steel procurement that we can adopt. So I will just cover some of the things like, what are all the points that we need to consider right at this moment. Just a minute. Yeah. So what we say from the buyer's angle, that we need to be we should be a bit we should keep a strong watch on the market, that how really the price would behave. For example, what is the market inventory right at this moment? So I was just talking to all the steel majors, both in the primary segment as well as in the secondary segment, about what is the inventory position of the steel. And just 15 to 20 days back also, I could find that all the steel producers, they were on a good inventory level, and they were pushing really high to basically consume their inventory, so that people can buy from them, and the prices they were keeping low. But this has really not helped quite a lot, because the producers were seeing a better demand in the flat products, and with that demand actually, and they were having a better price realization on the flat product. So the steel, the hot metal, they were moving towards the flat product, so that their long steel inventory get consumed during this period of time. So they were not producing much of long steel during this period, just to make sure that they strike a balance in the pricing. And today, if I talk to any of the steel producers, they are not that much pushing to take their long steel inventory, because they are also getting away gradually from the inventory. So this shows that we might not be in a position to really expect the low price to continue for so long a period. And it could be a good time that if we want to keep some inventory in our stock, only to the extent that it could be used even during the monsoon, this could be a good time to buy. Even you can continue to keep a bit of balance in your inventory level at this point of time, because the price is really at an attractive level. The gap between the primary and the secondary producer has also reduced. So if somebody wants to take the primary steel at this point of time, it's a real good period. One can buy the primary steel right at this moment. But I will advise that to the extent whatever you can consume in the near future, that only you can buy. You should not buy more, because monsoon, the consumption is not going to be very high. Now, between the primary and the secondary steel, today the gap is not really that much, because just in the last quarter of the last financial year, that is in the Q4, we have seen the gap between the primary and the secondary had gone up substantially. We could notice even 6,000 rupees to 7,000 rupees gap between the primary and the secondary people. And even me being the supply chain head of a infrastructure company, we had also moved quite a lot towards the secondary steel, and we had taken good advantage of the pricing. But today that advantage has reduced. I'm not saying that primary steel has touched the secondary steel price. Still, it is 2,000 rupees to 2,500 rupees more, or by and large at that level. So today, if somebody is very particular about the primary steel, they can continue to buy, because this is the best price, I can tell you. Now, the walk disruption in the monsoon is another point that need to be considered. Why I say this? Because the monsoon, normally we have seen the monsoon gets delayed. In the month of June, normally in the second week of June, we expect a heavy monsoon to start, but which is not happening. So there is all possibility that monsoon may defer to the July or something. And in this month, if somebody can really take some productivity out of a good geographical condition, I would say that you can buy at this level of price, which is very good, if the monsoon gets delayed to July mid or something like that. Now, the demand supply gap, I would say that the demand supply gap is not that much, because the demand is also demand is at a level which is moderate. I will not say it is very high, and at the same time it is not low also. So it is striking a balance, and the supply position is also good. So we can buy at this period of time, because the gap is not much. Infrastructure in all set to move north, and it is going to rebound like anything just post monsoon, because the third and the fourth quarter and the next will remain very bullish. The next financial year is a election year, and the present government is expected to remain, and whatever the projects that they have announced, they will also try to make sure that before the election it all starts, and it starts in a positive note. So naturally there will be strong push of productivity improvement at the site level. So that will continue to be bullish, and so the demand will really jack up. And with demand getting jacked up, I strongly believe that the steel price is bound to go up in the third and the fourth quarter. Geopolitical situation and the pandemic, which was quite a matter of worry and concern in the last year, we have gradually overcome the situation of pandemic. India is in a sweet spot of controlling the pandemic to whatever best it could. And today, the sentiment of the industry is very positive from that perspective. And we believe that we don't need to much worry about this. Geopolitical situation also, the way we had envisaged that the Ukraine crisis may lead to a bigger or worrisome consequences, is also found later on to be at a controlled level, and which is not going to disrupt much the global situation. So that way we are in a good situation in this perspective. Now, the long-term contract, because this could be one time when people may think that whether we should go for a long-term contract or we should continue to be a spot buyer. So I would say that long-term contract is good, but can you really strike such a deal with the steel producers? Because knowing fully well that price may go up in near future, I don't think that the producers will be in great mood to really go for a long-term contract. Because in my experience also, I have seen that long-term contract in steel in a volatile condition doesn't really work well, because sometimes it moves in the favor of the contractor, sometimes in favor of the producers, and always a tug of war continues, and this contract doesn't really stand good for both the party. So instead of that, I would say that it is always better to really become a situational leader, envisage the situations in advance, and then accordingly act. Means if you want to take some inventory which could move your productivity in the next one or a couple of months, I would say that you should keep the inventory rather than go for advance buying, and rather than going for a long-term contract, which may not work in good shape. So that is my perspective. You may differ in your means I do not know what is your buying strategy or the relationship with the supplier, but at least with me, long-term contract has not worked very much well. Rather, I always choose to be a spot buyer. However, I take the advance buying decision sometimes based on whatever the market forecast or the dynamics, how it moves. Then improvement in the payment terms. Yes, I can say one thing, because the market is really in a level where buyers can take a lot of advantage. So you can strike a better payment terms with the supplier. Now, wherever people are very much, producers, particularly in steel, either they sell in advance payment, or they sell in some payment terms, which is good for them. But again, for the EPC contractors, the cash flow becomes a problem. So you can always try to figure out a good payment term with the steel suppliers. A security-based credit policy could be a good deal that you can do right at this moment, and you can also really have a good cash flow situation, or rather, I would say that working capital impact could be reduced in this market. Then there are a lot of things which are coming up, like I would say the alternate material or the new technology, which is also coming up in the infrastructure sector. For example, in our company, we have already implemented the GFRP rebar, which is an alternate to steel, but not to all the applications, but wherever it makes sense to go for this alternate kind of a material like GFRP rebar. For example, it is not applicable for the load bearing, but at least for the distribution bars and all. For applications like this crash barrier, then this deck slab, or even the parking lot, or even this box culvert, then retaining wall and all, where the distribution bars can be, the steel bar can be replaced with the GFRP bar. So which can give you some kind of breather in your buying, and you can reduce your dependence on a volatile commodity like steel. So I think this is what, from my side, as a buyer's perspective, you can always choose your strategy depending upon what is the appetite and the ecosystem of your company. Accordingly, you can choose some strategy which can work well. So this is from my side. Thank you.
Lolita, you are on mute. Thank you, sir, for setting up the perspective. Sir, I am audible?
Yeah, you are audible. Yeah.
Yes, sir. Thank you, sir.
Just
Sir,
a
you
minute.
can stop sharing the screen.
Yeah.
Thank you for giving us the brief about the buying scenario with respect to the long steel.
Yeah.
Yes, sir. So now we will start with the question and answer session.
Yeah.
So looking at the current scenario where the market is volatile and raw material prices are also going down, what are your buying patterns now compared to earlier? Are you buying on long-term basis or short-term basis?
Yeah, this is a good question. I would say that I have clarified on this point. Basically, it depends. I would personally feel that long-term might not yield results at this point of time, because, it is my perspective, because long-term contract might be, it is not that easy to strike a long-term deal with the steel producers, particularly when they know that price is bottomed out and all set of increase that can take place. Now, at this price level, no supplier or no steel producers will go for a long-term contract. Even if somebody insists to go for a long-term contract from the buyer side, means steel producers will definitely mark up the price with a margin, and which may or may not work well to the buyer. So instead of that, my take would be to hold some inventory, to buy some inventory right at this moment at the price which is prevailing right now, and do the work at site for whatever is needed in the next couple of months or next 1 month time, and then watch the market also, because we have seen a lot of volatility in the market. Even if we predict something, uh, to by and large it applies, but again, there are some X factor which sometimes goes against. So it is better that if somebody wants some steel to be bought at a competitive price, today the price is really favorable, and people can buy at this price and keep some inventory if they have the requirement.
Thank you, sir. Thank you for answering the question. Sir, my next question is more of a follow-up question on the same buying pattern. Sir, since the monsoon has arrived and it has hit the other parts of India also, of course, you would be restocking for this period. Can you walk us through your pre-monsoon procurement pattern? What it is like?
Yeah, the pre-monsoon procurement, actually, our procurement, means the Q4 procurement always remains very high, because even in the last year also, this was no exception. The Q4 procurement was very high, with the fact that whatever the backlog in our cells that we had at various projects, so we wanted to jack up. So naturally, the Q4 procurement we had done quite hefty, and that procurement was predominantly done from the secondary steel producers, because the price gap between the primary and the secondary in the Q4 was quite a lot. And we procured from secondary, and we had reduced our cost of procurement to large extent. Now, this is Q1, which is just pre-monsoon quarter. Even during this quarter also, our buying was to the extent, because we had bought quite a lot in Q4. So it had given some inertia to our productivity at site, and we could consume many of that Q1 procured steel in the Q4 procured steel in the Q1. And so this quarter we are buying to the extent whatever is required pre-monsoon. As far as site requirement is concerned, we are buying to that quantity only. And we are also planning to keep some inventory at this price level for our this monsoon period. So whatever the small quantity that we can lift at this price level for this monsoon period, we want to buy now. So that is what my take is.
Thank you, sir. Nita, would you like to take the next question? Nita, we think that you are not audible right now. Your voice is not coming. I will take the next question, sir.
Yeah.
Sir, what could be the price trend in the coming quarter, and will there be any price pressure? What will be the consumption pattern in the short term?
Okay, the consumption pattern in the short term, if you talk about the next 3 months, the consumption will naturally remain low because of the monsoon, and but it will not be as low as the conventional monsoon period of other years, because there are a lot of projects which are awarded in the infrastructure sector in the month of March, and which have started also. So naturally, there will be some activity which is more than the last fiscal year monsoon. So those are, in order to continue with those activities, I believe the consumption will remain stable during the monsoon period also. So the price pressure, if we talk about, price will either remain at this level in 1 month time or something like that. But we are expecting some increment in the month of July, because going forward, the price of raw material has to go up, because price of raw material, as I have shown in my presentation also, have touched the bottom. So the international price of coal, international price of iron ore, or even domestic price of iron ore, then the coking coal and non-coking coal, both are going to increase. So naturally, cost of production will go up. So that will create some kind of a pressure on the pricing also. The upward movement of the price will happen. So in short term, I will say the price may move during this monsoon period around 1,000 to 2,000 rupees a ton. But in the Q3 and the Q4, the price will see the major leap from this level onwards, and price will rapidly move towards north. Means it will increase like anything. But in the short term, if there is at all some increment, it will be 1 to 2,000 rupees a ton during the month of maybe July or August.
So, sir, in the coming quarters, in Q3 and Q4, we can see many construction activities getting completed, and the prices can also move upward.
Yes, absolutely. As I correctly, you are very correct, because Q3 and Q4, lot of projects which are almost on the fag end. So naturally, they will try to commission their projects, and even from the government side also, that is a natural expectation that all those closing sites need to be commissioned, and all the new projects, whatever they have launched in the month of March, has to move up. So naturally, there will be a hectic activity during the Q3 and the Q4, and which will pull the demand up, and naturally the prices also have got a raw material price pressure, and demand also will go up. So there is all set to be an increase of price in the Q3 and the Q4.
Thank you, sir. Thank you for answering the question. Sir, my next question will be, do you see any impacts on the upliftment of the export duty on the buying activity?
Yeah, means obviously the upliftment of the export duty has created some kind of a domestic demand. Means the kind of good, I will say, the export scenario which India was having during the period before this. Actually, with the export duty change and the revision, I am thinking that price hike in the domestic sector has been contained, because the way the price was going up in the domestic sector because of the push the Indian steel industries were having for the export, that has now largely been contained, and that has only kept the domestic price also at a level which we can see today. Otherwise, the domestic price would have increased like anything. So I believe that the impact of that export duty relaxation has also given a lot of benefit to the buyer side, and it has a positive impact today, I would say. So that's the thing. Yes.
Sir, my last question from my side, then we will take a few of the audience questions. So what are the selection criteria for rebar, BF or IF route for various construction projects?
You see that we know pretty well that the coexistence of both primary producer of steel as well as the secondary producer of steel. The primary producer of steel is something there on the blast furnace route for iron production, and the LD converter route in the steel production in the SMS. And on the other side, the secondary producers is on the DRI for making the sponge iron, and followed by the induction furnace in the steel melting shop. So both the method of productions of steel are completely different. Now, I am not saying that primary steel is only good and the secondary steel is not as comparable to the primary steel. Today, even the secondary steel has also set a benchmark by themselves. So there are a lot of such secondary steel producers who are basically making the steel in an integrated steel plant. And there are good number of such integrated steel plant which has come up, where they are producing the steel right from the iron ore, and they are also having the DRI sponge iron plant, then the pellet plants, then the good induction furnace they have in the steel melting shop, and they are hot charging in the billet making, and finally this rebar mill, they are making the rebar, and which has also gained a lot of customers' confidence. But I would recommend that the people in the secondary producers, they should be continuously audited. They should be continuously, I will say that, under the supervision of the contractor. The contractor should, we as the customer should always see that how they are making the steel, and whether their steel making is following the entire SOP of making secondary steel. So that is the first criteria. The second criteria would be that the people who are having integrated steel plant right from iron ore up till the TMT rebar or the any other long steel, we should stick to those producers who are having the integrated steel plants even in the secondary segment. I would not recommend people who are there only the reheating furnace and the rolling mill, because they are buying the billets and there is no control where from they are buying the billets. So naturally, incoming billet quality is always a question mark. We cannot see that where from they are buying the billet, and sometimes it is not possible also. So naturally, the quality consistency level for those people will be less than the integrated steel producers. So that way, I would say that secondary producers, if somebody is selecting, they should always select people who are having the end-to-end solution right from the iron ore to the TMT making, and also to the people, also to those companies who have set credentials and who have earned the name in the industry. So that is what I would say. But even despite that, also secondary steel has got a lot of acceptance in the infrastructure segment. Today, if we see what is the blanket approval the secondary steel has got from the National Highway Authority of India, the list is quite a long list. But even in that list also, I would recommend all the buyers to stick to the people who are having integrated steel plant. That is what is my suggestions to all the buyers.
Thank you, sir. Thank you for answering our questions. Now it is time to take few of the audience questions, sir. So one of the interesting question which I am seeing is, why is India low consumer of long steel as compared to flat steel, sir?
Say again.
Sir, why is India the low consumer of long steel?
Okay. Okay. So I would say that the construction activity in India is still not has not really met the global benchmark. So India is definitely a developing economy for now. Construction activity is picking up the way now things are moving. I strongly believe that the construction activity will touch global benchmark in 3 to 5 years down the line, and the production of the long steel also will go up. The flat steel, you know pretty well that the usage of the flat steel is there in various industries, be it manufacturing, auto sector, and many other sectors, the export possibilities and all. But long steel is purely used in the infrastructure segment, be it road infra or building infra or any other infrastructure. And where India is still lagging behind the developed economies like China, the way it has taken its infrastructure, or the advanced nations kind of infrastructure they have developed quite long back. India has to match that kind of a, means global standard, and then only the usage of the consumption of the long steel will increase in India. But I am pretty hopeful that 3 to 5 years down the line, the long steel productions in India also will go up, and the consumption also has to go up.
Thank you, sir. So the next question which we will be taking is, on what basis we can expect the prices of raw material like iron ore and coking coal will go up in a month's time? Will there be any improvement in demand, or it will be unviable to sell below this current level?
Okay. Now I will tell you the coking coal and the thermal coal, both for primary as well as secondary, that has bottomed out. So if at all anything happens, it will be an increment that I can see in 2 months time. This is the level at which the price, I can see that there is a resistance. It cannot go below this level. That is for sure. Now, the Queensland mines, where from this Australian mines, where from this coking coal is coming to all the steel producing countries, is also a very, vulnerable mine. Means every year we see a lot of natural things that happens in that mine, and the supply line gets choked. So that also creates a lot of disturbances in the supply chain, in the coal supply chain, and prices go up. Now, I am not envisaging that also. Even if I look at purely the price aspect of international coking coal, the level at which it is hovering right now, which is around $230 or something, which is at a very low level. We have seen the coking coal at the level of $700 as well. In just last 2 years also, coking coal had touched $700 also. So I don't see any decrease in the coking coal prices, rather it will increase. If we talk about the iron ore, with NMDC now having some breather, or rather can provide a lot of iron ore. So iron ore prices, I can see that at this level, it will continue for some more time before it takes the next jump. And so iron ore prices should not change much. But the ferroalloys, ferrosilicon, ferromanganese, if you look at all those ferroalloys prices are at the bottom, and it has to increase. So naturally, in 1 to 2 months short-term period also, if we look at the raw material cost has to go up, and it will create a pressure, the cost pressure in the steel productions, and definitely the steel price has to increase. Even in 1 to 2 months, with further dip of around 500 rupees, 700 rupees, then onwards it will continuously increase. That is what is my understanding.
Thank you, sir. So we can see a upward trend in raw material prices also in the coming months.
Yes.
So next, we will move to the next question. So what are the infra industry's thoughts and trends on using 50 mm dia rebars for high-end infrastructure projects? Last year in India, it was introduced by JSPL.
FTMM dia rebar is not something used in common usage. It is very special rebar, and I would say that there is no immediate big chunk of requirement of 50 mm rebar, unless those kind of projects we get. Bigger dam, the bigger hydroelectric project, with all those kind of heavy infrastructural projects, when it comes up, then only this 50 mm rebar would come into play. But now that I can tell you, it is not only JSPL, even the other producers like JSW, Tata and all, they are also in the race of thinking of producing the 50 mm rebar. But it can be produced only by the main steel producers, because the kind of quality parameters this larger dia rebar demands, I believe it is only possible by the main steel producers like JSPL, JSW and Tata. Going forward, there will be a lot of heavy duty infrastructural projects which would come up, and I strongly believe that the larger dia rebar and also the Fe600 rebar, Fe700 rebar also could come up, because with more and more India is getting into the earthquake prone zone. So all those areas which were not there earlier, today you can see the quake has also gone up. So a lot of new properties that needs to be developed in the rebar. We know that there is 600 or 700 rebar. 700 rebar is very common in the advanced nations, because in Japan also I have seen people using all 700 rebar or even higher grade rebar, which is very good for the to fight the quake and those kind of natural calamity. But even in India also, the areas which are on the Himalayan plateau, which are there in the Gujarat or in Northeast and all, which are becoming more and more quake prone. And we have got a lot of such heavy duty hydroelectric projects and dam projects which are coming up. I believe this larger dia rebar with high grade is the future, and that has to come up. Having said that, I also see the huge push in the requirement of stainless steel rebar. Stainless steel rebar is also a future. I would say that wherever we are in the 20-kilometer vicinity from the sea, any projects that is coming up, infrastructure, I think that stainless steel rebar has also got a potential, because gradually people have understood the demerits of this fusion bonded epoxy coated bar, or even the corrosion resistant HCRM rebar and all. So naturally, stainless steel has also got a future. Yeah.
Thank you, sir. Sir, due to the time constraints, only one more question we can accommodate. And you have already introduced us to the epoxy coated rebar. The question is on that only. So what are the perspective of epoxy coated rebars in infra community, and would you as buyer prefer to use this for coastal areas?
You see, this is a cost economical solution. If somebody doesn't want to go for stainless steel rebar, this is a cost economical solution for sure, because epoxy coated rebar for the smaller dia rebar, 8 and 12, the price is something around 12,000 rupees a ton for the epoxy coating. And for the higher dia rebar, which 32, 36 mm or 40 mm, it comes down to around 5,000 to 6,000 rupees a ton. So naturally on the rebar price, this coating price, if we add, it gives much cost economy compared to buying the stainless steel rebar. But I would say that having said the good things, there are some flip side also, because in the epoxy coated rebar, I have seen the localized corrosion takes place. If there is any epoxy puncturing in the process, there are localized corrosion which takes place, and that localized corrosion weakens that portion of the rebar to such an extent which could lead to a bigger eventuality, and which is not good. So I would say that India was definitely a cost-driven country for some time, but now that we are transforming ourselves to a value-driven country, so instead of epoxy-coated rebar, we should move towards stainless steel rebar. Of course, the cost is more, and that the Indian government and the Ministry of Steel should think largely, and they should really allow the contractor to basically take into consideration the additional cost for stainless steel rebar. But this is future.
Thank you, sir. Thanks a lot. Well, that was a really interesting discussion that happened, and I hope our audience too enjoyed it as much as we did. I request our audience, if you have any more questions, you can email us and we will get those answered from Mr. Chattopadhyay. Due to time limits, we have to end this webinar here. A big thank you to Mr. Santimoy Chattopadhyay for taking out time to join us in this webinar. I also thank our audience for being with us throughout the session. Last but not the least, I thank our supporter, the Indian Steel Association. This is your host Pratik signing out along with my co-host Lalita. Thank you,
Thank
sir.
you. Thank you very much.
Thanks.
Thank you.